Satgon, 5 secret credit score hacks banks. Hope business owners never discover exposed. A client called me panicking last week. His business loan got denied with a 680 score. 3 weeks later, he had a 744 using these exact hacks the banks pray you never find. And here's what made me furious when I dug into this. Banks have known about these methods for decades. Credit bureaus have known. But they've built a multi-billion-dollar industry around keeping you confused, keeping you scared, and keeping you paying higher interest rates than you should. The average business owner with a 680 score pays $47,000 more in interest over the life of their business loans compared to someone with a 740. That's not a typo. $47,000 gone. So I'm about to show you 5 specific techniques that the credit industry actively tries to bury. One of them, the fourth one I'll share, actually uses the bank's own reporting system against them. When I showed this to a mortgage broker friend of mine, he said if everyone knew this, half his industry would collapse overnight. But before I get there, you need to understand something that changes everything. Your credit score isn't a measurement of how responsible you are with money. It's a measurement of how profitable you are to lenders. That's a completely different thing. Once you understand that distinction, these hacks make perfect sense because you're gaming a system that was designed to game you first. I've spent 11 years helping business owners fix their credit profiles, and I've seen people add 40, 60, even 90 points in under 30 days using what I'm about to share. The client I mentioned at the top? Marcus. Real guy, real story. And his transformation started with hack number 1. Here's what nobody tells you about credit utilization. And this single piece of information is worth more than every credit repair course sold online combined. Marcus had a business credit card with a $10,000 limit. He was using about 3,000 of it consistently. That's 30% utilization. Not terrible, right? The standard advice says stay under 30%, but here's the problem with that advice. It's designed by the credit card companies themselves. The real sweet spot isn't 30%, it's 7%. When I ran the numbers on Marcus's credit file, his utilization was killing him. Dropping from 30% to 7% alone would add an estimated 35 to 40 points. But here's the hack the banks don't advertise. You don't need to actually spend less money. You need to time when your balance gets reported. Credit card companies report your balance to bureaus on a specific day each month, usually your statement closing date. If you pay down your balance right before that reporting date, the bureaus see a lower number. They don't see your actual spending behavior. They see a snapshot. Marcus was paying his card in full every month on the due date. Responsible, right? Wrong. His statement was closing with a $3,000 balance, and that's what got reported. I had him switch to paying down his balance 3 days before his statement closing date instead of on his due date. Same spending, same payments. His reported utilization dropped to $400 on a $10,000 card. That's 4%. Within one billing cycle, he gained 38 points. No credit repair service, no disputing anything, just timing. Now here's something even sneakier that I'll explain in Hack 4. There's actually a way to legally increase your credit limits without applying for new credit, which drops your utilization even further without any credit inquiry. Most business owners have no idea this exists. The second hack attacks a different vulnerability in the scoring system, and it works especially fast for business owners who've been building for a few years. Your credit age matters. It's about 15% of your score. But here's what's criminal about how this gets taught. Everyone focuses on not closing old accounts. That's defensive. What you should be playing is offense. There's a strategy called authorized user trade lines, and while some sketchy companies sell fake ones, don't do that. It's actually fraud. There's a completely legitimate version that works inside families and business partnerships. Here's how it works. If someone in your life, a spouse, a parent, a business partner, has a credit card that's been open for 15 years with perfect payment history, they can add you as an authorized user. You don't need access to the card. You never have to use it. But that 15-year history gets added to your credit file. I helped a business owner named Diane do this with her husband's oldest card, a Visa he'd had since 1998. 26 years of perfect payment history. She never touched the card, never even saw it. Within 45 days, her average account age went from 3 years to 14 years. Her score jumped 52 points. The banks hate this because it's perfectly legal but completely undermines their system. They want you to spend years building history. They profit from those years through higher rates on young credit files. Now, there's a catch. Some credit card issuers have stopped reporting authorized user accounts to all 3 bureaus. American Express reports to all 3. Chase reports to all 3. Capital One does not. So before you do this, verify which bureaus the card reports to. Also, and this is critical, make sure the primary cardholder has utilization under 10% on that specific card. If they're maxed out, you're inheriting their bad utilization along with their good history. That's a net negative. All right, this third hack is the one that made me genuinely angry when I discovered it. Because the information has been available for years, but the credit bureaus have done everything possible to make it hard to find. You know how your score is based on credit cards, loans, mortgages, traditional debt? What if I told you that you're already paying for things every single month that could be boosting your score but aren't? Rent, utilities, your phone bill, internet, streaming subscriptions. You pay these on time, every month, for years. None of it counts toward your credit score by default. 0. But there are now tools that add these payments to your credit report retroactively. Experian Boost is one option. Free, adds utility and streaming payments. Average increase is about 13 points. But it only affects your Experian score. There are other services that report rent payments to all 3 bureaus. One business owner I worked with had been paying $2,400 a month in office rent for 3 years. 36 perfect payments, $86,400 paid. Not a single point added to her credit. We got 2 years of that rent history added to her reports. 24 positive payment entries appeared on her credit file in 1 week. Her score went from 661 to 698 in 12 days. Now here's where it gets interesting for anyone creating content or running any kind of online business. There's a tool I've been using called 11 Labs that does AI voice generation, and the subscription shows up as a software payment that can be reported through certain expense tracking services tied to your business. So if you're already paying for tools like this, check out their offer at try.11labs.io 2PU1 AL1. You might as well get credit score benefits from those payments too. You're already spending the money. The point is this: you have an entire history of reliable payments that's completely invisible to scoring models. Making that history visible is free money. If you're finding this useful, hit subscribe. I drop one of these every single day. Remember when I mentioned legally increasing your credit limits without a credit inquiry? Here's exactly how that works. And you can do this today. Most major credit card issuers have an option called a soft pull credit limit increase. No hard inquiry on your credit report. No new application. You just request more credit on an existing account. Here's the script that works almost every time. Call the number on the back of your card. When you get a representative, say this exactly. I'd like to request a credit limit increase. Can you tell me if this will require a hard inquiry on my credit report? If they say yes, say, I'd like to decline that and request a soft pull increase instead, if that's available. American Express, Discover, and most credit unions will do soft pull increases. Chase usually requires a hard pull. Capital One is inconsistent. The target? Request a 25 to 30% increase. On a $10,000 limit, ask for $12,500 or $13,000. Smaller increases get approved more often. Why does this matter? It drops your utilization percentage instantly. If you're carrying $2,000 on a $10,000 card, that's 20%. The same $2,000 on a $13,000 card is 15.4%. That difference can mean 10 to 15 points. Do this across 3 cards in the same week. Soft pulls don't stack negatively like hard inquiries. Here's the hack that most videos skip because it requires understanding something counterintuitive about credit scoring. Having more accounts helps your score, not hurts it. I know. You've been told the opposite your whole life. Don't open new accounts. It hurts your score. Partially true in the short term, completely wrong in the medium term. The credit bureaus want to see that you can manage multiple types of credit responsibly. Someone with 1 credit card looks like a higher risk than someone with 2 credit cards, a car loan, and a credit builder loan, all being paid on time. Here's the specific hack. There's a category called credit builder loans. They're designed for people with no credit, but they work beautifully for business owners with thin credit files. You pay into the loan each month. The money sits in a savings account. At the end of the term, you get your money back, minus a small fee. The lender reports your perfect payment history to all 3 bureaus. Self, MoneyLion, and Chime all offer these. Monthly payments range from $25 to $150. Term lengths from 12 to 24 months. Why does this matter? Adding an installment loan to a credit file that's only credit cards adds a new credit type. The scoring models, like diversity,